This is Behind Closed Deals.
We'll be chatting with multifamily maestros
Uncovering their strategies
and unraveling the latest market happenings.
Bringing you intel you can't buy. Hello, this is Hannah Ott with CBRE. Welcome to Behind Closed Deals. Today, I have 4 people from our team joining us. George Tikajan, also known as the godfather of apartments in Indiana or the Midwest or the universe, depending on who you're talking to. Cameron Benz, broker on our team, is with us, as well as Claire Hosfurther. And hiding in the background is Christine Nealis, who is making sure our podcast runs as it's supposed to every time, edits out anything that we say that's silly, and keeps us going. So we're excited to be speaking with you today. And today you're going to hear an overview from the 4 of us on the first quarter of 2025. And I remember most of you probably heard, oh gosh, a year and a half ago, people were talking about survive until 25. Well, if you're listening to this podcast, you did that. So good job. You survived until 25. And it's kind of interesting. What's happening this year is probably not what people were anticipating when they were saying that survive until 25. So we are going to talk to you about what we're seeing in our pipeline with deals that have sold, deals that we're bringing to market. We'll also talk to you about what we're seeing in the general market and give you some macro overviews. And so we'll get started with that. Sort of an overview of what our team has experienced in the first quarter. It's been a really active first quarter for us. We have closed 12 properties so far. We have 14 properties that are under contract, and we have 18 more that are either available or coming soon. So we have a really good sample set of what's happening in the market. Of those 12 properties that closed, they really represented all of the food groups. So we can talk about there was a brand new Class A non-stable deal, a brand new kind of stable deal in there, so some workforce housing, some small properties. We sold a property portfolio below $2 million. One of the properties was over $90 million. So we've got a lot of that intel and information. And so we're excited to tell you a little bit about that. Also, a first quarter update, non-real estate related, is Claire. Claire, you have something going on this second quarter. What's that?
I am about to have a baby. So in like 3 weeks, I guess really any day now, but likely in like 3 weeks. So yeah.
So Claire's going to take some time and be home for a period of time with her new baby. So she timed it perfectly so that she can enjoy the summer at the lake. And we'll be back with us probably in August after she has the baby. So, George, what's going on in Indianapolis? Not on the sales side, but on the market side, from what's going on with rents and occupancy. Are there any submarkets where there's anything interesting going on that would be interesting for our listeners to hear about?
Well, we're still seeing pretty stable operations at most properties. The lower rent level B and C properties, if they're well managed, are still doing pretty well. Rent increases have slowed down, so we're back down to what I would call normal rent growth in the market. We had a few years there where we were over 5%, over 10% in some years. We're back down into the low to middle single digits, depending upon the property and the operator. And it's back to, if you're a good operator, you're doing well. If you're a bad operator, you're starting to struggle. There was a period of time there where even bad operators were benefiting from a strong market. We've had new construction deliveries. They're pretty well concentrated in the northern suburbs and the southern suburbs. So some of those markets are a little bit softer because there's new units that have come on the market and the owners trying to lease them up. We're seeing some concessions. So places like Westfield, Noblesville, Greenwood, where there's been more units delivered over the past year, there are some concessions. We're seeing even as much as maybe 2 months free rent in some markets. And a lot of the properties that were built, those owners are trying to get them leased up, hoping to sell into the market. I do think we're seeing some nervousness and maybe some challenges on the renter side. The middle and lower income renter, maybe even the upper income renter, just like in the economy in general, there's some nervousness and maybe some challenges to pay rent. So we're seeing tick up in bad debts, in delinquencies. It's not across the board, but it's more prevalent than it was even 6 to 12 months ago. So that's sort of the quick what's happening in the rental markets.
Is Indianapolis overbuilt?
No, Indianapolis is definitely not overbuilt. There's, like I said, a couple submarkets that 2025 will be a challenging year to hit 93 to 95% occupancy and not offer concessions, but it's mostly newer product. Home buying is still hard. Prices are high, interest rates are high. So only the very tippy top of the rental pool can buy homes. So the market is not overbuilt and is generally stable.
Right. So a lot of the things that you mentioned are some reasons why Indianapolis and a lot of Midwest cities, but most of the cities in the top 10 rent growth throughout the country are in the Midwest. And Indianapolis feels like it's at a permanent place on that top 10 for about the last 5 years. So that, in combination with a number of things that George mentioned, the fact that we're not overbuilt, is still keeping people attracted to the Midwest, even with headwinds. So Cameron, what are we seeing on our deals that we're bringing to market in terms of number of groups looking, offer count, tour count, et cetera? How is this first quarter gone in that regard?
Right. I would say that we're still seeing a continued trend of what we saw at the end of last year, which is there's a preference for newer product, there's a preference for stronger locations. And if you're in that older product, there's just less CAs being signed, which means less people looking at the deals. What the good news is that we're seeing more offers and more tours per CA signed compared to last year, meaning you might still get the same amount of activity. You might still get 10 offers on your property, even though there's less people looking at it, which is a good thing. It means that every single person looking at the deal is actually taking it serious, right? When we call someone, they generally have questions, they're digging in, and they're going to spend time on the deal. But also in today's market, there's just less people coming out to tour. That's been a trend since COVID started. And really, part of it is that our team does an awesome job with exterior, interior drone videos so people can get a feel for the property and don't feel like they need to fly out to see it in order to have an idea of what the location is like or how to underwrite CapEx. We do a lot of guidance for that as well. But also, we're sick and burnt on spending so much time flying out every single week for all our best and finals and then losing the deal ultimately. And they remember that.
That's right. That's
The,
right.
the other thing that's important is underwriting is more important now than it had been in the prior couple years. With escalating operating expenses, we have to be very careful with how we're underwriting deals. Some expenses we can chalk up to an owner spending too much money. Other expenses, they're just higher, and buyers won't buy off on forecast expenses that are lowered too much. We're being very careful with insurance because insurance is escalating in some cases more than others. And equity is harder to raise. Equity, I think, is scrutinizing deals more. So it just requires a better level of underwriting to properly price properties and have successful marketing campaigns.
And the way we underwrite properties is ever evolving. It's ever evolving because we're always trying to follow what's going on in the market. So we track very closely our price, our end price to BOV, meaning our BOV is what we tell you we think we're going to sell the property for, and the end price is what it actually sells for. And we're generally around 103% on a 5-year average, but they're meaning we sell the property for a little bit more than we tell you you're going to. There were 2 or 3 quarters in that 23 timeframe where we were about 1 or 2% off, meaning our underwriting was too aggressive and buyers did not agree with us. So in the 20 through 23, beginning of 23, it felt like we got more and more aggressive on each BOV that we did. It feels like the opposite is true now, meaning we're getting a little bit more conservative in general right now on the BOVs, on BOVs and properties we're underwriting on, based on the actual feedback that we're getting on deals that we're marketing. So go ahead, George.
I was just going to say, so this time last year, although I'm sort of forgetting timeframes, but everybody was assuming, the market was assuming that interest rates were going to decline, so they'd get a little more aggressive at underwriting future cap rates. As interest rates have stuck at a higher level than people expected, they're just becoming more and more conservative with their future cost of capital underwriting, their residual cap rates. And, we try to anticipate, but, we're largely underwriting to what we're seeing today. So sometimes if the market moves in a positive way, like Hannah was describing, with when interest rates move down, we end up doing better than our initial underwriting. Or if rates move up or expenses move up and it takes 6 months to sell a property, then our BOVs may not, we may not hit the BOVs.
Right. So we give that price to BOV stat, and it's what is a little bit unfair about it, though, is that it does not include properties that don't sell. So we still sell more than 90% of our listings. It used to be like almost 100%. But if a listing doesn't sell right now, it's generally because of price. It's because either our underwriting or the seller's expectations, or often a combination of the two, were not aligned with what buyers would actually pay. So, and this is most exaggerated, it feels like right now, in product that is 60s and 70s vintage. So we have a great case study for this because we just brought 2 properties out to market and we have selected buyers on both of them in Northern Indiana, in good submarkets, but in secondary submarkets, Mishawaka and South Bend. They're 60s and 70s, very well maintained properties, but that vintage does, make buyers look at them differently. So, Claire, talk about who came to the table, like what kind of groups came to that table on those deals and sort of where cap rates shook out.
Yeah, so I would say right now, if you're willing to buy those older vintage 60s and 70s deals, you've got a great opportunity. We still ended up getting about 10 offers on each property, which was great. We had several in-person tours, or I'd say probably 5 to 7 in-person tours.
Yeah.
Yeah, the groups that came out were all private capital, and it was a mix of groups that were really local to South Bend and also a mix of out-of-state groups. We ended up selling or awarding the deals to one local group and one out-of-state group. So you're still getting a mix of that buyer pool, but I would say for the secondary markets, it's going to be people that are more familiar with the location in general. But it's a great opportunity right now if you're willing to buy outside of Indianapolis, because you're generally able to get a higher in-place yield.
And Cam, where do buyers tell you cap rates need to be in order to sell that 60s and 70s product?
I think it varies. I think that the stronger operators are getting rewarded now for the hard work that they put in for their hold period. That for South Bend, that operator did a great job, right? When you go to the properties, it shows there's an arborist that takes care of it. So someone feels more comfortable that they can raise equity for a 70s property. we've worked on plenty of deals, all of us have, that are beat up properties, negotiation of the property, and every buyer feels the risk. They feel the risk and they price it in. They need higher returns. They say we need to be at a 7 cap, need to be above a 7 cap.
And that's what
Yeah, the other thing we're seeing is there are buyers that are hesitant to spend time on properties that have traded within the last few years. Oftentimes, the buyer who bought a property 3 to 5 years ago, they've probably benefited from rising rents, so the revenue is better than when they bought it. But another strategy that some buyers have done is to lower operating expenses, and owners that have operating expenses below what it takes to maintain a property over a long period of time, because their goal was to buy it and flip it in a few years, we're seeing more pushback on from buyers who aren't willing to accept below market operating expenses,
Mhm.
even if the actuals show it, because the owner has been, yeah, just not spending as much on the property, or at least showing it on their financials.
Yeah. We've lost a very specific, it feels like, subset of buyers that used to be really aggressive on workforce housing, 60s and 70s product, and it tends to be the younger East Coast-based syndicator. And we think there's a couple of reasons for that. One, they made some purchases over the last couple of years, in some cases, a lot of purchases, and they underwrote moderate or lower expenses. And unfortunately, expenses because of inflation have gone up. And so they're paying more for insurance than they had anticipated. They are paying more for payroll than they had anticipated. And so while they've had rent growth, some of their expense growth has been more than they anticipated. A lot of those deals also closed with bridge loans. And those bridge loans are now having to be replaced by either a new bridge loan, which is the keep in mind what happened to SOFR over the last couple of years, how much it went up. So either they're having to replace that bridge loan with another bridge loan, and now they're underwriting quite a bit a higher interest rate. And so there's a gap there's an equity gap there. Or they have to sell it, and perhaps because of expense increases and not as much rental rate increase as they anticipated, that NOI is not as high as they wanted it to be. So they're trying to solve for some of those issues. So it's very hard for them to raise equity, or they've decided to pause for a moment.
Uh,
We've lost that group.
Generally, those who need to sell in order to put a permanent loan on to replace their bridge loan with an agency loan, it's a cash in refinance, and a lot of the equity investors just don't want to put more cash into the deal, and the sponsor doesn't want to, so they're opting to sell. And they structured their partnership where the general partner benefited from upside in the property, and if they don't hit the upside, then it's challenging for them to sell because they may not make any money. So we've seen people delaying selling properties because they're not hitting the prices, or they don't think they can hit the price they want. But to survive until 25 that Hannah started this conversation off with, there's folks that don't have any more time and are going to have to do something. So we are starting to see more people selling, even if they can't hit the numbers that they want. And the other thing that, Tam, I don't think that you mentioned specific cap rates. For the B and C properties, we're at the point now where, unless there's something unusual or there's a huge amount of upside, we are seeing mid-6 cap rates, or in some cases north of that. So whereas a year ago, we were probably pricing and buyers were in the upper 5s to lower 6s, we're mid-6s and above now. And probably will be until cost of capital goes down, interest rates go down.
Right. And what we're also seeing, that cap rate premium for those 60s and 70s properties, which is new now. It used to be that everything sold at the same cap rate. Everyone was solving to the same returns. Now you do get a premium for buying that.
Damn, that's new to you. But is that new to you, George?
Yeah.
But it is new in the last 5 to 7 years. That's absolutely right.
That's what I'm saying.
That's
But
right.
if we talk about, and I'm sure you're about to get into this, Hannah, the Class A product and the well-located product. Big, big pricing difference. I call it a bifurcation. The pricing difference between the A and the B is dramatic. And I remember having conversations 3 years ago. We'd say there's no difference between A and B, and that's because the cost of capital was primarily driving cap rates in 2021, 22, when interest rates were, below 3%. Now, cost of capital is only one factor that's driving cap rates.
That's right. So you read my mind, George. I was like, I can only talk about 6.5 and 7 caps so long before I start to get nauseous. So we're going to go to the other side, the other bookend. So sort of to finalize, 60s and 70s product, just absolutely buyers for it. There's capital for it. There's a very attractive agency debt for this type of product. And there are deals out there that you can buy that are in this cap rate range, that mid sixes. And so these are very, very strong, double digit returns and, approaching 20% IRRs. Those are out there.
And if you haven't, excuse me, Hannah, if you haven't financed a B or C property recently, the spreads on those, because that's considered mission-driven financing for the agencies, the spreads are amazingly low, down to, below 120 basis points over the 5 or 10-year treasury. So it is very attractive.
That's right. And as Cameron pointed out, though, there's a big spread now between where cap rates are for Class A and that is for Class C. And that is a new nuance to the more recent market. So of those 12 properties that we actually closed on already this year, a number of them were Class A. 3 of them were in Hamilton County, which is the highest income, highest growth county in the state. And one of them sold at a 4.8 trailing cap rate. One of them was 45% occupied, and so sold at, no cap rate basically, but the forecast cap rate is low 5 or really basically at 5 on a pretty aggressive forecast. And another one was also just barely stabilized. I think like the week of closing, it got to 90% occupancy. But if you used 90% occupancy with the current rents, it would have been a sub 4 cap. So Class A, well-located properties are still highly, highly in favor. Buyers are underwriting rent growth to them. They know where their expenses are going to be because M&R is more of a known thing because of vintage and age of the property. And there's equity readily available to buy those properties.
Yeah, Hannah, I would equate that to gold. So people are buying class properties just like they're buying gold now. It's a hedge against inflation. It's a hedge against geopolitical, macroeconomic uncertainty, and it's like gold.
Yeah,
over 3,000 an ounce, over 300,000 a unit.
One of those properties closed $400,000 a unit, so over 375 a unit. So very strong price per units, very low cap rates, and great terms. One of those deals that we sold was an all cash transaction that closed within 30 days. One of them was, no occupancy hurdle, nothing like that for a property below 50% occupancy, and that was a 1031 exchange buyer. So we have 4 more properties actually in Hamilton County coming to market this quarter.
Now, that being said, we need to be realistic here.
Well, that's why you're George.
Those 5 caps or sub 5 caps, there aren't going to be 10, 15 offers at that, right? It's usually a specific buyer that has a specific need and sees the specific benefit of that particular property.
Yeah, we've been talking about the special circumstance buyer. Cam, what's some of these special circumstances that get folks to get aggressive on these Class A deals?
Usually what everyone thinks, 1031 exchange buyer, but we've seen other ones, owns a nearby property, change of business model altogether and from one type of real estate into multifamily, or just in general, a partnership change where they are trading out of properties into separate properties or something like that.
Or they've raised capital in a fund or some other structure and they need to place it. There's not that much for sale in the country. And so uh, they'll pay a nice premium price for a well-located newer property.
Yeah, it's a really like perfect timing, great phenomenon of for owners of Class A properties that are interested in selling because people are interested in the Midwest in general. So that just puts a glow over the Midwest. Sort of the darling of the Midwest is Indianapolis and really Columbus, Ohio. But people are excited about those markets, and because of the way taxes are handled in Columbus, Ohio versus how they're handled in Indianapolis, you can buy a Class A buy a Class A deal in Indianapolis at a much lower cap rate and still have the same yield as if you were buying one in Ohio because of the resizing of real estate taxes. So you have more people looking at the Midwest. You have more people looking at Class A and really 2000s or even 90s and newer property. So you're going to have good competition. And the air is a little bit thin at the top, meaning like our best buyers, there's not 20 of them out there, but we're still getting good competition. So you'll not just have just one, you'll have 2, 3, 4, 5 groups at the top that'll really compete. And then somebody eventually does differentiate themselves. So to that end, we have a pre-stabilized property that we're launching today in Carmel. We have a early 2000s renovated vintage deal in Noblesville. We have a pre-stabilized deal in Westfield, and we have another one coming, but we can't tell you about it just yet. You'll have to stay tuned for a couple of weeks. But we've got good product in this type of subsection that is coming to market that we anticipate really strong interest on because of all of the things that we just mentioned. Now we have lots of 60s and 70s properties that you can buy too. So if you're like, I'm not buying a 4A cap. Yeah, that's right. You can say, I'm not buying a 4A cap. Then we've got some great 60s and 70s deals that you can buy as well. So it's easy to let your perception of what's going on in the market be colored by sort of what you're experiencing right now. But really, when we actually look at the data of what's happening in the Midwest, specifically in Indianapolis, in Indiana, it's steady Eddie rent growth. It's a great business environment to have a business here and to do business here. And there is inventory to buy and properties are selling. So from a sales standpoint, it is strong still.
And I'm sure people want to know what's going on from a distressed property standpoint. We're not seeing very many properties getting to the point where lenders are taking them back. We're certainly talking to more lenders or owners where that is sort of moving down that path. But, we've just not seen very many REOs. I anticipate as the year progresses, we'll probably see more, but certainly not a flood. So a lot of the capital that's been raised to take advantage of the expected REO distressed business, either they're going to go to other places where there may be more, or they're just going to have to buy other assets that aren't quite as distressed and cheap as they expected it might be.
That's right. Guys, did we forget anything else that's really important to talk about for the first quarter in the Midwest?
I don't think so.
Well, we'll give you another update after the second quarter, which will include a baby from Claire, some more Class A deals, some more workforce deals, some more Class B deals. So we'll have more to report after that. But really appreciate you guys joining. And remember what George always says, you're only as good as your next deal.
Bye.
Bye.
Bye. Thanks, guys. Thanks for tuning in. Stay in the loop by hitting that subscribe button. and check the show notes for additional resources.